Bitcoin has been in the news nonstop lately as prices crater from their highs last year. But why should real estate investors care? Today, we're going to break down what's driving Bitcoin's plunge, what it says about broader risk assessment and sentiment, and how that could ripple into the U.S. real estate market. This isn't crypto hype. It's real economic flow dynamics that influence capital markets and borrowing costs. So as a builder and investor, I never thought that I'd be looking at cryptocurrency so closely, but it does now affect money supply. And so we need to look at these things. And the world's biggest cryptocurrency has been sliding in recent days. Bitcoin recently fell below $70,000 and at one point dipped into the $60,000 range, which that's its weakest level since 2024. And that wiped out much of the post-election rally that it experienced. So analysts describe the market as entering capitulation mode, where investors are aggressively selling off, often in response to the broader risk-off sentiment. So what's driving this drop? Bitcoin isn't falling off for one single news event. It's a combination of broader risk-off forces. So there's risk aversion in the markets. Bitcoin has historically moved with sentiment towards risk assets. When tech and NASDAQ stocks weaken, Bitcoin, it often falls alongside with them. And institutions are selling and ETF outflows are occurring. So big money managers have been reducing their exposure, and that lowers liquidity and affects Bitcoin in a bad way. Liquidations and leverage positions, well, the traders who borrow to buy Bitcoin, well, they're being forced to sell as prices slide, and that can be a pretty hefty money call. And post-rally correction, well, as I talked about before, Bitcoin peaked around 126,000 in late 2025 and has given up roughly half of those gains, which is a normal pattern after parabolic rallies. So overall, Bitcoin's plunge is not a single shock. It's the result of broader risk aversion, capitulation selling, and macro sentiment, which is pulling capital away from what's considered a highly volatile asset. So here's what real estate investors need to pay attention to. Bitcoin's price movement increasingly act as a sentiment indicator for risk appetite in financial markets. And studies show Bitcoin's correlation with traditional assets like the S&P 500, especially since the introduction of a broad crypto ETFs, it can be meaningful, and meaning crypto and equities often move in tandem. When investors shift away from high volatility assets like Bitcoin, they also tend to reduce exposure to other riskier or higher beta asset classes, including speculative real estate investments. Now let's talk about capital allocation. The real mechanism by which Bitcoin's drop could influence real estate is this. When risk appetite falls, investors move out of risky assets, crypto, growth stocks. Demand grows for safer assets, treasuries, cash, sometimes certain real estate income plays. And capital flow patterns change, often very rapidly. The flight to safety effect means some investors re-risk via high-quality real estate or fixed income products, while others de-risk entirely and just hold cash. We've seen this before in periods when risk assets tumble. Traditional assets with stable cash flow, like core real estate or government bonds, they often attract more capital due to their perceived safety. This is a huge thing, and the dynamic can tighten cap rate spreads and support valuations for lower risk properties. So Bitcoin's decline alone doesn't move real estate prices, but as a risk sentiment barometer, it can signal shifts in how capital flows across different markets. And another thing about Bitcoin, there can be an indirect channel of financing conditions that it can affect. So when risk assets fall sharply, investors shift into safe haven assets like U.S. Treasuries, driving yields lower. Mortgage rates may respond, albeit with a lag, to changes in the Treasury yields, and lower yields can potentially support borrowing costs for real estate buyers. For example, in this recent market weakness, yields on the 10-year Treasury fell to around 4.19%, contributing to a softer mortgage rate with expectations. Now, to be clear, that doesn't mean that mortgage rates will plummet overnight, but in the context of risk-off markets, demand for safer instruments often increases, which can put downward pressure on yields and indirectly affect mortgage markets. So before anyone goes down the panic route, though, let's be clear on what Bitcoin's fall doesn't signal. It isn't a direct catalyst for a housing price crash. Crypto prices are not a major component of mortgage financing or property valuation models. And it's not inherently a systematic banking crisis trigger either, at least not at this time. Because according to the Federal Reserve Bank of New York, digital assets remain a relatively small part of traditional financial intermediation, meaning that their direct contribution to systematic risk, including real estate, it remains limited at this time. So while Bitcoin's slide does shine a light on investor behavior, it isn't on its own a housing bubble detonator. So as we look ahead, here's how this plays into the real estate market. If risk appetite continues to decline, which we're seeing with the Bitcoin coming down, investors may prefer low-risk real estate assets with more stable yields. That's great for build to rent like we do, and potentially supporting valuation floors for more core properties. So if broader markets rebalance again, and they sometimes do after larger corrections, capital could return to these more riskier assets, changing real estate demand patterns fairly quickly. Now, continued macro volatility might slow real estate investment activity as capital waits on the sidelines, and that will compress transaction volume. Most of the experts out there are saying we're going to have a higher transaction volume overall with real estate sales, something I'd like to see. We're not sure. I'd like to see if Bitcoin actually has any effect in this. In other words, the direction of capital flow, not the absolute Bitcoin price, is what matters most for property markets. So here are the key takeaways for real estate investors. Bitcoin's drop doesn't directly crash housing markets, but it reflects a broader shift in risk tolerance, and that can have influence on capital flows, yields, and financing conditions. When Bitcoin enters what some analysts call a capitulation mode, it's a sign that liquidity preferences are tilting towards safer bets and away from high volatility positions. We like that a lot because with build to rent, we've been called some of the safest investments there are, workforce housing, and that's where we like to look. And that shift, if it sustains, can actually reallocate capital across more asset classes, including BTR real estate. So don't look at Bitcoin prices as a house price predictor. It's not. Look at it as a market sentiment gauge. And when sentiment turns risk adverse, capital will change where it's going, and that's extremely relevant for anyone underwriting long-term property investments. So what happens in the crypto markets? Can it echo far beyond crypto? Will it change real estate? Again, I think we've gone over some key things that will help assign what value will be given. It will be some, but not all. And again, risk appetite does matter. This will affect risk appetite over all markets, but certain ones will have a greater attractiveness to them because they're seen as less volatile and a steadier return. Rental cash flow real estate in the workforce housing seems to have a great component to it when these periods of time come. So as an investor, you want to look at what will the markets respond to most likely, where will the capital be available. That's why we're going to keep building the type of houses we build. And if you'd like to learn more about the houses and what we're doing exactly to follow these types of financial markets, click subscribe. We'll look forward to having you on the next video.